confused about credit scores? Well, if so, you're not alone, friends. With so many different credit scores out there, it's no wonder people feel lost about which one really matters. And here's the kicker. That confusion is one of the biggest reasons that families feel like home ownership is out of reach for them. But the truth is, the real reason your mortgage application might get denied, it's not what you think it is. Have you ever checked your Credit Karma score? You felt pretty good about what Credit Karma was showing you, but then you had a lender come back and tell you something completely different, like your score was 60 points less? Well, what if I told you that the score you see on those apps, like Credit Karma and some of the other apps, they might not even be the one that your lender actually uses? Let me give you a real scenario. Let's say you're getting ready to buy your first home and Credit Karma shows that you have a 680 credit score. You are confident, you are excited because you're like, woo, I got this. You maybe even start telling your friends and family about your plans to buy a home. But then when you go sit down with the lender, they tell you that your actual mortgage score is a 540. See, that gap between what you thought and what's real completely changes the outcome for you. It could be the difference between an approval and a mortgage denial. But here's the good news, friends. This doesn't have to happen to you. Understanding the difference between consumer scores and the mortgage scores lenders actually use can save you thousands of dollars in interest and protect you from unnecessary heartbreak. See, I ran a credit repair business for several years before becoming a licensed realtor here in Hampton Roads. And I've seen firsthand how credit confusion destroys dreams and how credit knowledge creates generational wealth. See, I study and educate myself consistently on credit and lending, even though I'm a realtor, because I want to be a resource for families. Even if I can't help them buy a home today, I can help them get there tomorrow. So while I serve Hampton Roads directly as your local realtor, I also help families nationwide through my incredible agent network. And this is why I'm so passionate about bringing this information right to your doorstep. And friends, I hope this helps you.
Hey friends, welcome back to my channel. If you are new here, hey, I'm Sonali Hutson, and on this channel, I strive to combine faith, inspiration, and real estate to bring you the fire that encourages your heart with kingdom principles and equips you with biblical wisdom to make confident real estate moves. Are you ready for it? Let's get into it.
And today we're talking about your credit foundation for home ownership, and I'm going to give you the blueprint that takes you from credit confusion to credit confidence. This is actually the first video in my credit masterclass series, so make sure you subscribe and hit that notification bell because we're going to dive deep on everything credit related in the coming weeks. Now, if you already own a home, I can't tell you how important it is to still understand and maintain your credit. I can't tell you how many people have ruined their credit after buying their house. Life happens, right? What if you fall behind on your payments? What if you go through a bankruptcy or a divorce that could cause you to lose your existing home and you need to buy another one? See, I want to put you in the best position to buy again if needed, but I also want to educate you on the purpose of your credit. So let's just say that you're already in your forever home. Okay, I get it. You're never going to have to buy another home. But what if you need a HELOC or a home equity line of credit so that you can renovate or consolidate your debt? You still have to qualify for that HELOC, so your credit is important. Be careful, friends. Don't let home ownership be your climax. You have to maintain your credit even after securing your keys because, guys, listen, cash is king. But credit is queen, and we all know who runs the house, right? In my time in the credit industry and as a realtor, I realized that most people really don't understand how credit actually works overall. And they especially have no idea how it works in mortgage lending. People are most definitely confused about the different score types, what they should look at, and most importantly, what they can do to not just improve their credit, but maintain it. So whether your credit report is great or okay, it needs some work, there is a path to home ownership for you. I've helped families with credit scores in the 500s get approved for mortgages, and I've helped families with 800 credit scores understand why they still need to improve in certain areas and maintain that excellent credit. So in this video, I'm going to break down everything you need to know about credit. So we're going to start with the basics and talk about what credit actually is and how credit actually works. Sound fair? Let's get into it. Credit is essentially your financial reputation. It tells lenders how you manage money that you borrowed in the past and predicts how you're going to handle it in the future. Now, there are actually dozens of different credit scores, guys. There's so many of them. And the ones that you see on the free apps are probably not the ones that your mortgage lender is going to use. See, based on my extensive research on credit scores and my time in the industry, mortgage lenders use three specific FICO models called FICO Score 2 from Experian, FICO Score 5 from Equifax, and FICO Score 4 from TransUnion. These are often called the classic FICO scores, and would you believe they can be 20 to 50 points different from what you actually see on Credit Karma or other consumer apps? Yes, y'all, credit score variances are real and they can be super confusing. So what that means for you is if you're a buyer, you need to know your real mortgage scores, not your consumer score or your Vantage score, your real mortgage score. So let's keep going. There are 5 factors that make up your FICO score. Payment history makes up 35% of your score. This is whether you pay your bills on time or not. Did you hear me say it makes up 35% of your score? So guys, the first clue, pay your bills on time. Credit utilization is 30%. This is how much of your available credit that you're using. The length of your credit history is 15%. That means how long you've had credit accounts open. Now your credit mix, or the mix of credit that you have, makes up 10% of your score. That's having different types of credit like credit cards, student loans, car loans, etc. And finally, new credit is going to make up the final 10%. And that's new accounts that you've recently opened. When lenders pull your credit, they're looking at much more than just your credit score. And a lot of people don't know this. They pull what's called a tri-merge credit report that shows them your scores from all 3 credit bureaus, which are Experian, TransUnion, and Equifax, your payment history, your current debts, and any negative marks like collections or late payments. Now, what underwriters actually see when reviewing your file is a complete picture of your financial behavior, not just a single credit score. What we know for sure is that past behavior usually predicts future behavior, and this is usually what gets you approved or denied for a loan. If a lender sees you as a high risk based on your past behaviors, it's going to be hard for you to get a loan, okay?
You know what, friends? Every single day, people just like you reach out to me because they want to relocate to Hampton Roads. And I absolutely love providing them with the information that they need to make confident real estate decisions. And that's exactly why I have created several comprehensive home buyer and home seller relocation guides that are going to blow you away. And guess what, guys? They are absolutely free. I'm talking completely free. That's right, friends. These guides have everything you want to know. I'm talking neighborhood breakdowns, market insights, moving timelines, school information, and all the insider knowledge that we talk about on this channel. All you have to do is click the link in the description below, and I'll send these incredible resources right over to you.
Now let's talk a little bit about what your typical credit score needs to be for a home loan so that you can see the role that credit plays in a mortgage. Now, if you're looking to qualify for an FHA loan, you're going to need a minimum of a 580 credit score for a 3.5% down, or I've seen some scenarios where buyers could purchase a home with a 500 to 579 credit score with an FHA loan, but they had to put a minimum of 10% down. And I've also seen buyers in a lower credit score have to put 20% down when their credit scores are below that 580. Now, this can work if you have pretty good cash reserves, but let's say you're buying a $300,000 house. Do you have 20% to put down? If not, you really need to get your credit scores up. The higher down payment helps reduce the risk that the lender has since your credit score is so low. You following me, guys? Are you with me? Does that make sense? Okay, now let's talk about for VA loans, because a lot of people in this market use a VA loan. The VA actually doesn't set a minimum score, but most lenders want to see a 620 or higher. Now, I have some lender partners that have told me they can go as low as a 580 on a VA loan, but I still recommend to my buyer clients that they should come in the door with the highest possible credit score that they can have. When your credit score is higher, that means your loan terms are going to be more favorable. Now, if you're looking for a conventional loan, you need a 620 minimum credit score, but a 740 or higher is going to get you the best rates. And when you have a better rate, again, that means more money in your pocket each month and less going towards your mortgage. Now, I haven't done too many USDA loans, but I do believe that most lenders want to see a 640 or a higher credit score in order to get you approved for a USDA loan. Now, we touched on it briefly, but let me give you a real dollar example of how your score impacts your monthly payment. Let's say you want to purchase a $300,000 home with 10% down, and you're a qualified borrower with the 620 credit score. Now, if that's the case, you might pay about $150 more per month than someone with the 740 credit score. Now, over 30 years, that $150 extra a month is $54,000 more in interest. Sit with that for a moment. $54,000 is your child's college fund or your retirement security. And with interest rates changing frequently in today's market, every single point on your credit score matters more than ever before. And this is why I'm always going to encourage you with real talk, because the lender says that you can qualify with a 580 credit score, but that doesn't mean that you should buy. If there are things that you can do to get your credit score a little higher so that your loan terms are better, by all means, guys, let's wait, let's prepare, and then buy when we are at a better credit score. Does that make sense? process. So now that you have a little bit better of an understanding of what a credit score actually is, let's go ahead and talk about the other factors that lenders look into when trying to make a loan decision. See, your credit score works together with two other major factors in approval decisions. One is your debt to income ratio, or DTI, and that shows lenders how much of your monthly income is going to go to your overall debt payments. So let's get into that a little bit. Most loan programs want your debt to income ratio to between 43 to 45%. Now there's also your loan to value ratio, or your LTV, and that's how much you're borrowing compared to the home's value. So the higher your credit score, the more flexibility that you're going to have with your debt to income and your LTV requirement. Now Jesus taught us in Luke 14:28 that we must count the cost before building. And understanding these three numbers together, your credit score, your debt to income ratio, and your loan to value ratio, helps you count the true cost of home ownership and not just give you some imaginary scenario that has no foundational basis, okay? Now friends, do you see why understanding these components help save you thousands of dollars in interest and get you to the closing table quicker? I want to talk to you now exactly about how to get your real mortgage scores. First, you're going to go to annualcreditreport.com. That's the official site authorized by federal law to provide free credit reports. You can get one free credit report from each bureau every single week. And did you hear me say it's free? They're going to give you the detailed credit report information, but you're not going to get your credit scores from there. For your actual FICO scores, remember, we want actual FICO scores. You have a few options. Now, Experian offers FICO scores 2 through their premium service. Equifax provides FICO score 5 through their paid monitoring. TransUnion offers FICO score 4 through their subscription services. Now, you can also ask a mortgage lender to run your credit. They can sometimes do a soft pull, and many are going to do this at pre-qualification with no cost, and they'll give you your scores. However, I personally use myfico.com. There's a paid subscription as well as a free version. The free version gives you your credit report and a free Equifax score each month. But if you want all three scores and all three credit reports each month, it's going to cost you about $39 a month. But guys, I'm telling you, it's well worth it. There are some other programs out there, but since the FICO score is the premier score that mortgage lenders use, I personally feel safe with using myfico.com. Now, if you want to sign up for MyFICO, the link is going to be in the description. Okay, once you have all three of your credit reports, here's exactly how to read and understand what you're seeing. I'm going to run through this pretty quickly, so you may want to take some notes. Now, the first step is to carefully review all of your personal information for errors. Check that your name is spelled correctly, check your social security number is accurate, your current and previous addresses are correct, and your employment information is up to date. You also want to look for any accounts that are not yours. This could indicate identity theft, and that's very important for you to monitor. Check that closed accounts are showing as closed and that account balances and credit limits are also accurate. Now, the second step is to review your payment history section, which again makes up 35% of your score. Look for any late payments that are marked as 30, 60, 90 or more days late. You want to pay special attention to anything within the last 24 months because recent late payments hurt your score more than older ones. And if a mortgage lender sees a late payment within the past 12 months, you're probably going to get an automatic credit denial. So you want to work on paying your bills on time. If you see a late payment that you don't remember making, write down the creditor name and date because you might want to dispute this with the creditor or ask them for a one-time removal as a courtesy. Now, your third step is to identify any collections, any charge-offs, any bankruptcies, or any negative marks on your report. Write down the creditor name, the amount, and the date that it was reported. Look at the status. Is it showing as paid or unpaid? Is it within the 7-year reporting period for most negatives or 10 years for bankruptcies? Some of these might be eligible for removal even if they're accurate, depending on their age and status. Now, we can talk about this more in detail when we have a credit consultation. You can click the link in the description or text me at 757-837-0096 if you want to discuss a specific plan based on your needs and your situation. Now, the fourth step is to review your credit mix, which accounts for 10% of your score. Look at what types of accounts you have: credit cards, auto loans, mortgages, student loans, personal loans. Lenders like to see that you can manage different types of credit responsibly. If you only have credit cards, you might benefit from adding an installment loan, but don't just take on additional debt for credit mix. If you have a car loan or a student loan with no credit cards, adding a credit card might be a smart decision even if it's a secured card. However, make sure you choose those cards wisely. Now, the fifth step is to calculate your credit utilization on each individual card and your overall utilization. Here's the math that you need to know. Take your current balance, divide it by your credit limit, and then multiply it by 100 to get your percentage. For example, if you have a $500 balance on a $2,000 limit card, that's 25% utilization. Do this for every single card and then add up all of your balances and divide by all of your limits for your overall utilization. You want to ensure each card has an absolute maximum of 30% utilization. But if you want to look like a rock star and make sure that your approval is solidified, ensure each card is under 10% overall utilization. Now, the sixth and final step is to look at the inquiry section. You'll see two types of inquiries: a hard inquiry that can affect your score for up to 2 years, and soft inquiries sometimes show up as well, and they don't impact your score at all. Make sure you recognize all the hard inquiries. If there are any that you didn't authorize, that's a red flag for identity theft, and you can dispute it. Make sure to write down this information because, again, you may want to dispute this information later. Friends, if you want to learn more about getting pre-qualified and understanding exactly where you stand, I'm giving away my credit score action plan checklist that breaks down exactly which steps to take in your first 30, 60, and 90 days to improve your credit. Now, get this resource plus my Hampton Roads homebuyer guide by texting 757-837-0096 or by booking a free consultation by clicking the link in the description. Listen, I've got your back. And if you want to know what loan program you may qualify for based on your credit score before talking to a mortgage lender, here's how we're going to help you calculate and look into that, okay? So I want you to take your middle credit score from all three bureaus. That's what lenders are going to use. It's literally the score in the middle. If your middle score is 580 or higher, you're likely going to qualify for FHA financing with 3.5% down. But keep in mind the other factors that are involved, like your debt to income. If you're a veteran with a 620 or higher, VA financing might be your best option with 0 down payments. Now, if your score is 620 or higher and you have good debt to income ratio and some money on hand, conventional financing could work. But most lenders want to see a higher score for conventional financing, so just keep that in the top of your mind. However, they're going to look at the full picture. Now, if you're looking for a home in a rural area and you have at least a 640 or higher score, a USDA loan might offer 0 down payment financing, so don't forget about a USDA loan. Now, friends, I promised that I was going to give you a step-by-step guide with actionable steps that you can take right now if you're looking to buy a home. So let's go ahead and get into it. Again, first, get your free credit reports from annualcreditreport.com and review them using the 5-step process that I just gave you. Second, if you find any errors, go to each credit bureau's website and file a dispute online immediately. This typically takes about 30 to 45 days to resolve. Or if you get myfico.com, you can dispute directly within the app. Third, if you have high credit card balances, calculate 10% of each card's credit limit and then create a payment plan to get each balance below that 10% threshold, starting with the cards closest to their limits first. Fourth, set up automatic payments on all your accounts for at least the minimum payment due to ensure that you never miss a payment going forward. Late payments can literally kill your credit. Now, if you want to buy a home in the next 3 to 6 months, laser focus on utilization and fixing any errors on your report. These can improve your scores in 30 to 60 days and get you in a home much quicker. Now, if you have a 6 months to a year before you plan to buy, you can work on paying down debt systematically and building better payment history. Pay off your smallest debts first for quick wins and then tackle your larger balances as you go through the process. Think about the compound effect, okay? Small changes today are going to put you in a much better position tomorrow. Does that make sense? And friends, of course, if you have more than a year before you plan to buy, you can implement longer term strategies like asking for credit limit increases so that you can improve your overall utilization ratios and keeping older accounts open to maintain your average account age. But all of these things are going to help you. Just be sure to check your scores monthly using one consistent source. But don't obsess over small changes because your credit scores can fluctuate 10 to 20 points normally pretty frequently. Don't panic when you see the fluctuations. This is why I'm recommending having a credit monitoring service that can help you stay on point and keep you from stressing out about your credit scores. I want you to focus on a 3-month trend rather than daily fluctuations. Keep a simple note, or if you're fancy, you can keep a spreadsheet with your scores, utilization percentages, and any other actions that you take each month so you can keep track of things. I want you to set specific measurable goals like reduce total utilization by March or eliminate all collections by June so that you can stay on task. Do not get overwhelmed. It's one step at a time, friends. You can do this, and I'm here to help you. And all you have to do if you need support is reach out. Now, you'll know when you're ready to start house hunting when these 4 things align. When your middle credit score meets the requirements for your chosen loan program. When your debt to income ratio is within guidelines for that program that you're looking for. When you have money saved for down payment and closing costs. And most importantly, when you have stable employment history for at least 2 years. When all of these stars start to line up, you might actually be ready to buy. Until then, friends, let's keep plugging away so that we can get your home loan approval, okay? Does all of this make sense so far? Y'all, for real, getting your credit together and keeping it together is about so much more than just buying a house. It's honestly about stewardship, being faithful with what God has entrusted to you. And let me tell y'all the truth, credit has been a hard hill for me to climb. I'm not gonna lie. From the time I turned 18, I had bad credit. I'm talking really bad, y'all. I literally could not get a bottle of water on credit. And I was so ashamed and so embarrassed because I had no idea where to start. That's what actually led me into getting into the credit business. I wanted to learn how to legally and affordably fix my credit and help other people do the same thing. And guess what? Even after getting my credit right, life still happened. I still made some bad financial decisions and I had to start all over again. But Proverbs 22:7 reminds us the borrower is slave to the lender. And I was literally feeling like I was a slave to my debt and my credit score that I had worked so hard to improve. But what I've learned and what I hope I'm impressing upon you guys in this video is that when we manage credit wisely, we position ourselves for freedom and not bondage. If you want to be free, you have to have a plan. So save this video, walk through the steps and get in touch if I can help you. I know what it's like to feel desperate and to feel like you've messed up beyond repair. But if there is still breath in your body, you still have hope, friends. It may take a little bit more time, but you have hope. Proverbs 13:22 tells us that a good person leaves an inheritance for their children's children. Your credit foundation is part of that inheritance and part of that legacy that you should leave for your family. You don't have to do this alone, guys. If your credit needs more work than you can handle on your own, consider working with a HUD-approved housing counseling agency. They offer free credit counseling. I can also recommend a credit repair company that I trust, but again, I'm always going to encourage you to do it on your own. So if you're ready to start the pre-qualification process, just reach out to me so I can connect you with a trusted mortgage professional who can review your specific situation and help you get into a home. Now, before I close the first video in my credit series, let me know if this video is helping you out. Drop a comment below. And while you do that, let's quickly recap what we covered today. First, you learned that Credit Karma and similar apps don't show you your real mortgage score. You need to see your actual FICO scores, which are FICO 2, 4, and 5. Because these are the scores that lenders are going to use. Second, you discovered that your credit score works together with your debt to income ratio and your loan to value ratio, and improving all of these gives you the best rate and the best terms when you're looking to buy a home. Third, you now have a specific action plan with exact steps to take in the next 30, 60, or 90 days to improve your credit systematically. Remember, with interest rates changing almost daily, every point on your score is going to matter more than ever. See, the path from credit confusion to house keys isn't always quick, but it's absolutely possible. I've seen families transform their financial futures by understanding and improving their credit on their own. I've watched first-time homebuyers who thought home ownership was impossible get their keys within months of starting their credit repair journey. And personally, I have dug myself out of credit holes that would make you cry. And not only did I do it once, guys, I did it twice. So you absolutely have no excuse. I'm teaching you not only what I did myself, but what I've extensively researched and what I've helped countless families do. And your story can absolutely be next. So let me ask you this, friends, and I really want you guys to answer this for me. What's one action step that you can walk away with after watching this video today that can get you closer to home ownership? You can drop a comment below or text me to let me know exactly what step you're going to take. I'd love to hear about your progress, and I'd love to hear you. I'd love to be able to cheer you on. Friends, I really pray that this video was impactful and helps you understand credit better. In our next video, we're going to dive deeper into credit topics that impact not only your home ownership journey, but that's going to impact your financial life.
Friends, thank you so much for watching my channel. Your support absolutely means the world to me. I love helping people relocate to and from the Hampton Roads area. But listen, even if you don't need a realtor in Hampton Roads, listen, I still got your back. I have amazing relationships with incredible agents nationwide, and we're going to work together to make sure that you have an amazing experience, no matter where you're moving from or where you're moving to. So if you want to work with me, you can. All you have to do is text me at 757-837-0096. You can also drop a comment below. Don't forget, I drop new videos every Thursday evening and every Sunday evening at 6 p.m. I also drop daily afternoon shorts to keep you winning in real estate. Thank you so much for watching, friends. Listen, don't forget to like, comment, and subscribe. Without you, I cannot grow this channel, and I'm trying to reach 1,000 subscribers this year. So thank you so much for your support, guys. I can't do this without you.
Thanks again for watching, friends, and I'll see you in the next video. God bless you.